But you're the treasurer of Illinois. Illinois has numerous pensions. It has serious underfunding, which obviously you're well aware of. Pensions invest in private equity. You also just passed a statewide ESG legislation. You care about these issues. You are also yourself a fiduciary. So how do you square this circle when it comes to private equity investment, or is it an unsquareable? Like, how do you do this in a way that is positive?
Yeah, I think I go back to some of these remarks Delilah made. There are different kinds of private equity. It's tough to follow Damon here because he's probably not convinced that all private equity is bad. There is definitely bad actors out there. But there are some that are better than others. And in regards to that Stop Wall Street from Looting Act, I'll just let you know you can oppose that. I penned an op-ed, made it on the Hill, political magazine in Washington, D.C. I want you to know, though, one of my friends from college who then went on to work for the Koch brothers did not like my op-ed. He reached out to me and complained. So if you have friends who are friends with the Koch brothers, you might have some backlash. I took it in stride. So let me tell you about our experience in private equity, because I am not a sole fiduciary. I am one trustee on one of the state pension funds, but with our state funds, about 16 years ago, the General Assembly gave the state treasurer the ability to create a technology development account. And the idea behind technology development accounts was impact investing, trying to make an impact on the growth of technology companies in the state of Illinois. Allow the treasurer to invest up to 1% of our portfolio in venture capital and private equity. And the original reason was venture capital. The goals were twofold. One, get a nicer rate of return. Two, spur economic development in technology companies in your state. So a double bottom line. This was a good idea. This was a good idea that I had supported many years ago because I live in a community, Champaign-Urbana, home of the University of Illinois at Urbana-Champaign, as the university is named. That university has a great engineering program, great computer science program. Ideas have come out of there, like Netscape was the first commercialized internet browser started at the University of Illinois. We've had companies sort of launched out there by graduates, things like ePay or PayPal. If you go far enough, the transistor was invented there, LEDs, flat screen TVs. And when all of these ideas that were generated at a state university, funded primarily by state dollars, when most of them were commercialized, they left Illinois. And they tended to go to Silicon Valley. Maybe they went to the East Coast, maybe they went to Boston. And I've been to San Francisco. They have great water there. But there is no magic in their water out there. Why do these companies have to move to the Bay Area? Well, it's because the venture capital firms investing in these companies said you have to move to San Francisco. Basically because they have the money, they're going to make the rules, and they don't want to get on a plane and fly halfway across the country and then get on a puddle jumper down to Champaign to be involved in their investments, so they want their investments closer to them. So we had the idea, well, how do you stop this? If you want to retain your talent you've invested in, state tax dollars going to that university, if you want to retain it, well, one of the things is we found Illinois-based venture capital came down to Champaign and looked at a startup company, a graduate student, a professor who started, and wanted to invest. None of them ever suggested they move to San Francisco. They said, okay, we're going to invest. Keep doing what you're doing. This is a roundabout long answer here. The idea, so as we started, we're going to invest in Illinois-based venture capital that also included private equity. Now there's a real push, especially with pension funds. When your pension fund is tasked with generating a return, from 7 to 7.5, maybe 8% return. Now, over the last decade, those returns in the stock market, except for immediately right after the global financial crisis, have been really difficult to attain. As Dana pointed out, you have these private equity firms saying, we can do better. We can generate 12, 14, 16% returns. It is really attractive. And so when we passed these technology development accounts in Illinois and allowed us to invest in private equity as well. It's something we looked at. But what we saw was the big firms out there, the ones that really engage in leveraged buyouts. Maybe they can meet that return in terms of interest, part of one of our two goals. The other was generating jobs in the economy. They failed there. But we do find that smaller private equity firms that really get into smaller companies have been able to generate good returns and help them to be actually able to help grow jobs. One example we found with one of our private equity firms, WinPoints, found a company on the south side of Chicago, Evans Food Company. They make pork rinds. Not a very exciting, flashy company or so. But they realized, they looked at it and said, well, there's this real kick towards fewer carbs. Not a lot of carbs in pork rinds. And there's a big growth in Hispanic people moving into the state of Illinois and throughout our country. And this is a food they use. They saw an opportunity there, and rather than coming in and buying the company and selling it off, breaking it up into pieces, they decided to invest. And they've taken this company from 200 employees to 400 employees. So I'd say we find examples out there of firms that actually are doing good work, are helping companies to grow, but you have to be very careful. And we actively choose not to invest in those ones that engage in leveraged buyouts. And we choose to engage up front at that point of sale, that point of leverage. Before we give them our money, we look through the agreement and we make suggestions, other things we would like to see. We want to see a commitment to diversity and inclusion. We want to see a commitment to transparency, frequent transparency and providing information to us. And if they don't sign these side letters, which is a special agreement for us, then we don't invest. And so that's my sort of advice here in Hawaii. There are horror stories. There are things you should avoid. But it doesn't mean they're all bad, but you have to be very careful. And so when you talk to the limited partners, make sure that they are asking those questions up front and they're making that commitment for Hawaiian values, for diversity, for transparency, what we try to do in Illinois.
And anyway, to be clear, you've been successful in getting those funds into your investments, correct? Like, you're successfully doing what they're talking about, which is pushing back at the point of leverage.
There's an echo in here.
Oh, sorry.
I can't hear you.
Okay. Now it's not working.
It might just be here, and the speakers are pointed out that way. I'm having a tough time here.
You gotta catch when you give them the money, because once you give it to the money, you can't call it back.
Well, I mean, part of the reason, yes, once you give the money, we think they're free to do what they want, but we have the ability to check in with them. The side letters we sign say that they have to disclose, and we have opportunities to continue to engage with them. If you are forceful, we tell them to sign up the front, those are the rules.
They want to come back.
Yeah, because most of them, they take money and leave, but they keep coming back. What do you, Damon mentioned Fund 8. That means at least 8 times they come back and say, how would you like to invest in this new fund? And if they treat their limited partners badly, they're probably not going to invest in funds 2, 3, 4, 8.
So, Rod,